Boa tarde a todos. Uma honra a gente estar aqui mais uma vez com o Jay Pelosky, na nossa live quinzenal, falando do Musings. E nessa semana, quer dizer, dado que a gente tem bastante gente falando sobre isso, vamos falar bastante sobre o Brasil, sobre, quer dizer, brincando um pouco com a última capa da Economist. Okay, so now, it's an honor, as I said again, to host, Jay Pelosky. It's our pleasure. We do this, every other week, and now there's lots to talk about, and I guess we'll start with Brazil this time. So let's, over to you, Jay. So what do you mean, by the last Musings title, about the covers, and how does that relate to Brazil and all that you have seen here throughout your career?
Well, thank you, Roberto, and it's great to be with you again, and of course, all the folks in the OHM research group. Always fun, and these every other week live sessions seem to come up almost every other day. It seems like we were just together a very short time ago. But yes, I titled the last Musings from Friday "Classic Cover," and what I meant was not the cover of some famous rock song or something, but more the classic business magazine cover, which doubles as a contrarian indicator. And in this case, I'm referring to The Economist in their cover last week of Brazil, calling it a dismal decade for Brazil. And I thought it's going to probably go down in history as one of the classics of the genre of these business magazine covers, which kind of get it exactly wrong in terms of their timing. And I think that's the case in this instance as well. And we've touched on the fact that I like the Latin American currencies. We've talked about the Brazilian real going from 5.75 to the dollar, now almost all the way down to 5. Looks like it wants to go lower, and in many cases should go lower. And then also the Mexican peso, again, looks like it wants to strengthen against the dollar. And the stock markets have done much better over the last month or two. And in fact, in our model portfolio, ILF, which is the Latin American regional ETF listed here in the US, was the best performer in the model portfolio for the month of May, up about 12%. So, I think The Economist had it wrong. And the opportunity in Latin America, both equity and FX wise, is pretty compelling for the second half of the year.
No, that's great. And of course, this is no offense to the publication. It's a very thorough one, but and a lot of the things that they say are mostly right. It's about the diagnosis of the country, but a lot of that is looking backwards. And I guess it's like the opposite of the Rockefellers shoe shine story during the just pre 1929 crash, because if when everybody knows about these issues, they gotta be in the price, and they are not in the business. They're not in the business of doing market timing. They otherwise they would have a hedge fund of their own. But it's interesting, and how these things have worked pretty well. And there's a ton of other examples, not just related to Brazil, but just how it goes.
Well, you're absolutely.
You out quite well.
I was just going to say, Roberto, you're absolutely right. And, they had a famous oil cover. I think they've gotten oil wrong, repeatedly. And other publications have as well. Barron's, the very well-known weekly financial market publication, had on its cover a week or two ago, inflation. And that probably is one of those things that signals the peak in concerns about inflation. And my old boss, Barton Biggs, very famous investor and strategist, used to say that the news doesn't have to get better, it just has to get less bad. And I think certainly in the case of emerging markets and markets like Brazil and Mexico and others, that a lot is already in the price the news is probably not going to just turn around and become fantastic, but it's probably already in the price, as you say, and is going to get less bad in terms of thinking about COVID, less bad in terms of thinking about the economy, less bad in terms of thinking about the beneficial impact of significantly higher commodity prices, particularly bullish for Brazil. And these things suggest that that bad news has kind of led to a split between the Brazilian equity market and its traditional historical relationship with the major commodity prices. And so we have commodity prices now leading the cross-asset world in terms of year-to-date performance, and Latin American equities, until very, very recently, trailing quite far behind. And so when I think about things like the economists cover, what that tells me is that the kind of the generalist investor, maybe the global investor, is not really exposed to Latin America or to Brazil. And in fact, I saw Bank of America, one of their recent research publications, showed a table that suggested net flows to Brazilian equities year to date are negative, still negative. And
yeah, so because they were very bad in the first quarter.
Room. Yeah, and so there's tremendous room for the non-EM specialist investor base, which is obviously huge, much bigger than the specialist investor base. There's tremendous amounts of room for them to allocate to some of the Latin American markets, which even within the EM space itself, and you and I have talked about this before, back in the day, LATAM used to represent 75% of EM. Now it's flipped completely, and China itself, plus South Korea and Taiwan, that represents 75%. So Latin America, it really has an opportunity, in my view. I expect in the second half of the year, kind of the laggards to lead the way, both DM and EM laggards. And in DM, that's Japan, and in EM, that's Latin America. And so to me, I'm very constructive, and LATAM equity is one of the biggest regional equity allocations we have in our model portfolio.
Yeah, no, fantastic. And before I forget, I mean, correct me if I'm wrong, but was it Barton Biggs that also said that a bear market by definition ends in the point of maximum bearishness?
Yes, exactly. He had a lot of those sayings, but yeah, that was another one of his. And he and I together, we back in the day when I was running a Brazil fund for for Morgan Stanley, we traveled together to Brazil, we traveled to Mexico. Barton knew those markets, personally, as well as from a distance. And so, those are a lot of those sayings kind of stem from some of the emerging market experience, because flows are so important, right? They flow in, the flow out. It's been that way for 20 plus years. And while obviously in the case of Brazil, there's a big institutional ownership market of financial assets, the foreign investor still plays a major role. And that investor, for the most part, has been a seller of Brazilian and Latin American financial assets. And for them to come back into the market, I think would be, quite supportive. And I expect that, as I say, the relationship is very, very clear. If you go back 20, 30 years, the tie-in between Brazilian equities and the commodity index, very clear. The Brazilian equity market has not changed that significantly. Commodities, materials, et cetera, still very significant. And so I expect that relationship to reattach, and not by commodities selling off, but by Brazilian equities kind of outperforming and Latin American equities broadly outperforming here in the second half of the year.
That's totally right. And even if commodities, are not, that greater as a share of the market, I mean, you have the trickle down effect from higher commodity prices. So, that means, higher tax revenues, and, people are talking about, a trade surplus in a record high of $90 billion this year. So all of that tends to benefit the economy. And you're right. I mean, you called this early on when, I would say late March, early April, at the height of the COVID deaths and still a lot of uncertainty on the budget. You called this very well. And just to remember that, if you look at the other major emerging market currencies, mostly the South African rand and the Mexican peso, they're already stronger than they were pre-COVID, and the real is 25% weaker. So there's a lot of catching up to do, and a big premium for the let's say the fiscal issues and the other ones we know. So there's a lot of room for error, I would say.
Yeah, no, I think that's absolutely right. And, we're certainly invested that way. We have a position in EMLC, which is the local currency emerging market debt. Brazil and Mexico are two of the four biggest weights in that index. China is another big weight there, and the China currency very strong, highly unlikely to sell off in any material way. And then Indonesia is the other one. So the big four there, I think, are all pretty solid and have pretty much quite a bit of room to continue to perform, both on the equity side and the debt side, given that currency outlook, particularly in the local currency space. So, yeah, to me, it's a situation where I'm very bullish on commodities. I think there's a multiple leg super cycle that's just underway there, and as we talked about already, that syncing up or coming back together, the traditional relationship between commodities and Brazilian equities, both for the direct relationship and the indirect that you spoke of. When you have a $90 billion trade surplus, you should do pretty well. Your currency should not be, massively undervalued. That just does. That's an anomaly that I think is going to be fixed in the near term via a stronger Brazilian real.
No, fantastic. And can we now move on to your portfolios? I was reading the Musings, and you have just rebalanced your portfolios, and now you have two. You have a traditional kind of countries and sectors, and with the traditional asset allocation methodology, but you also have another one which is purely thematic. So how is your thought process? How do you go about this? And especially, how much overlap there is between one and the other, if there is such a thing?
Yeah, no, perfect. Great questions, and happy to discuss the general outlines of the model portfolio process. It's something that we do quite a bit of work on here at TPW Advisory. And we have, as you know, and you mentioned, a global multi-asset model portfolio that we've been running for some time. And that over the last several months or so, actually going back to last year, has really had a pretty significant thematic component to it. Roughly 20% of that multi-asset model is in thematic ETFs, with climate being the single biggest category of the thematic space. And interestingly enough, in my latest monthly, the second half outlook, I actually changed part of my process. I removed a component in my global risk nexus work, which is the fundamental process for me. I removed the health component, arguing that COVID has really kind of finished as a main driver to either economics or markets, and I replaced it with climate. And I argue that while COVID, from a financial market point of view, has been kind of a one-year event, maybe 14, 15-month event, climate is going to be a decade-long, at least a decade-long event. And therefore, investors must learn to understand it, understand what's going on, and look for ways to profit from it and participate in all that's going to change in terms of decarbonization, electric vehicles, power generation, et cetera. And so as I went through this process over the last couple of months, I thought to myself, it would be really interesting to do a full thematic portfolio. And so we launched it last month. We call it the TPW 20, so Tripolar World TPW Advisory 20. And that 20 means there are 20 specific ETFs. So I really worked hard to kind of consolidate and slice and dice, let's say, or position and size that thematic model portfolio with only 20 ETFs. And so it covers about 9 different categories, including, as I say, climate, which was the single biggest at about 25% of that portfolio. But we also have health, infrastructure, reopening, crypto, cyber. We hear all the time now about cyber attacks. So if you think that, we've advanced digitalization and the digitalization of everything, cybersecurity becomes much, much more important. And therefore, we have a pretty decent slice of cybersecurity ETF exposure and so on. So we have the 100% thematic global portfolio is made up of 20 ETFs, 9 or so different thematic categories. And I'm really excited because to me, thematic is a natural extension of global macro, which is kind of how I would consider myself to be a global macro multi-asset investor. You think of thematic, very much driven by politics and policy. So two of the things that are the bedrock to global macro investing and analysis. And what I also like about it, Roberto, is that thematic cuts across the traditional sell side metrics in terms of sector and country allocation of research departments. You and I know very well, right? It's financials, it's industrials, it's technology, it's Europe, it's Asia, it's United States. Thematic cuts across all of that. And so there's really an opportunity to kind of outperform or position in ways that is very hard to do when you're looking at the straight traditional sectors of the market. And then the other thing is that the bulk of these thematics are made up of small to mid-sized companies. And so the weight of the thematic constituents in the traditional indices, which investors are typically benchmarked against, is very small. So there's a real alpha generating potential, I believe, particularly over time. So if you're a longer term investor, you really should be thinking thematically, and you really should have at least a portion of your allocation or a portion of your portfolio allocated to these themes. And so I decided that we at TPW Advisory would launch a 100% thematic global model portfolio. And I welcome anyone here to reach out to me to discuss it further, but we're quite excited about it. There is some overlap, as you would think, because why create the wheel twice? So the bulk of the thematics that are in the global multi-asset model, as I mentioned, is about 20-odd%. They're all in the 100% thematic model, and in fact, we actually pulled one of the thematics from the 100% thematic and added it to the global multi-asset. And it's really helpful in terms of thinking about how to position, how to size, how to allocate. And so to me, as a global macro multi-asset investor, I'm looking at thematic as a way to add an edge, as a way to add alpha to the traditional construction of model portfolios.
That's fantastic. And before we move on to the next topic, let me try to address some of the questions from the audience. So, there's one talking about art. So, how do you see your thematic investing, vis-a-vis with what these guys are doing?
Yeah, ARC is, very impressive in their breadth and depth of their analysis and their research. I think Kathy Wood and her team, have become like poster children almost for thematic work. And to some extent, that's overstated in terms of, their ability to drive markets, as we've seen in the last couple months. But they are what I think is really impressive is that they provide a guide to a number of these different themes, right? Because if you're going to be a global macro asset investor and you're going to be a firm or a company that looks at that, you're not going to be expert in genomics and in cyber and in crypto and in carbon, etc. So you need to be able to have guides who can help, direct you in these different spaces, which are all kind of specialized spaces in and of themselves. And so for me, I like to look at what ARC does and what other people do in that space as a guide for helping me to direct my attention. That doesn't mean that I slavishly follow their suggestions. It doesn't mean that my thematic portfolio is stuffed with every single ARC, fund or vehicle or ETF. I think in the multi-asset portfolio, there's one ARC vehicle out of 28 separate positions. And so I think the real benefit is the guide and the work that they're doing. They're doing cutting edge work, but they have a long-term time frame, and they make no bones about it. Kathy has been very explicit about, they look 3 to 5 years down the road. So if you're looking for them to give you guidance on a 1 to 3 month basis, that's probably a mistake. And that's where actually, technical analysis, I think, really comes into play. And not to switch gears away from the question, but one of the things we should talk about, I think, is the role of technical analysis in the current markets. But I think ARC is doing impressive work, and they are one of the folks that I look to in terms of their research to guide me as I think about all the different thematics and how to approach them and how to size and position them.
No, that's great. Our next subject is, the inflation boogeyman, and of course that has links, to the payroll report next year, and you have really stick to your guns with inflation call. And I remember since the beginning of the year saying that the best way to make money, on inflation is simply ignore the noise, ignore the debate, and keep carrying on. And on top of that, I mean, is it right to say that last Friday's payroll was, as good as it could be?
Well, you and I touched on that a little bit before we went live, and certainly it was a number that the equity market liked and the bond market liked. So I think you're right? The bonds rallied, stocks rallied. It was a solid number, but not too hot. It wasn't 1 million jobs that would have spooked people. It wasn't 200,000 like the April number. So probably was quite, as you say, just about perfect. But I want to, before we really go into the inflation, I just want to step back and touch on this technical analysis subject a little bit, because one of the things that I do in the portfolio review process is go through the technical positions of pretty much every single holding. And it was really illustrative when I did this last week for the June model portfolio update. It was really telling in a sense that of the 28 positions in the model, almost all of them looked very solid technically. So notwithstanding all the news you hear about, bubble and overdone and expensive and all this kind of stuff that I guess sells newspapers or captures eyeballs, I think it's just completely misplaced. And so when I went through all the positions, as well as a half dozen or dozen of on our watch list, almost all of the positions technically looked very solid. So that tells me that we don't have to fear a major correction in the equity market. And then the other thing that it told me as I continued to look at across asset technical levels is that a lot of assets are on kind of important levels. If you look at parts of the technology space, Apple is flirting with its 200-day, I think just broke it last week. If you look at Bitcoin and GBTC just broke its 200-day average Friday and again today. The bond market is on important technicals, and the dollar is on important technicals. So technical analysis in a market like this, where fundamentals are hard to kind of get a handle on because you are looking at unprecedented volatility, technical analysis is something that I think really can help. And so I'm of the view that technically the market is quite sound. I don't agree that the market is overly expensive. I don't agree that we're in a bubble. I think we're actually in a pretty well underpinned global equity market expansion that's in its early phase. And so I think there's more work that can be done. And I'd just make one further point that I touched on in my monthly and again in the Musings on Friday is work that JP Morgan has done that shows that the growth segment of the US equity market is as cheap as it's been relative to the S&P in 35 years. That's an important thing to pay attention to. The growth segment of the US equity market relative to the broad equity market is as cheap as it's been in the last 35 years. That tells me that we don't really have to worry about a big sell-off and crash in the NASDAQ space, which tells me that the US market probably is going to underperform, but is not going to crash, which then tells me that you have upside opportunity in the rest of the world as we move from this kind of staggered reopening to what I think is going to be in the second half of this year and into 2022, a synchronized global economic recovery. And that synchronized global economic recovery is what is going to drive earnings higher and is what is going to take commodity prices higher. So that's going to be the second leg of that commodity bull market I mentioned. The first leg was just the V off the COVID bottom. The second leg is moving from staggered reopening to synchronized global recovery. And then there's a third leg, which is the whole ESG impact on supply and demand for clean energy related materials. And we can, get into that more down the road. But I think at the moment, technical analysis suggests that the equity markets are in good shape. It does suggest that there's maybe some action coming down the road in the foreign exchange market, which we can touch on. But I know that you wanted to talk about inflation, so we can come back and talk about FX later. And on the inflation side, you're absolutely right. You and I wrote that piece now back in February. Hard to believe that was 4 months ago.
Yeah.
But we said exactly that. Keep calm and carry on. And it's been 100% correct. And I think it's going to continue to be. And I just note that in the U.S., at least, the city U.S. inflation surprise index has shot up like a rocket. I think it's peaking as we speak. We get the CPI number for May this Thursday, I believe, and I think that's going to be the last of the big inflation numbers because it's the last where the COVID collapse really depressed year ago May inflation numbers. Going forward, June and July and August, et cetera, we'll have more kind of like-for-like comparisons on a year-over-year basis. And so my view has been and continues to be that the testing time on the inflation argument is probably going to be late summer, early fall, around the August Jackson Hole meeting.
Jackson Hole, yeah.
Or more likely the September meeting for the Fed, because then you're going to have clean data. You'll have a couple of months of clean data to kind of actually see after the collapse and the rebound and after all the stimulus, what do we have going forward? And I think that's where you have thin markets because it's in the summer. You have seasonality, not that great. So that's where I think we should, we can really focus in on our attention on inflation. But to me, actually, as time passes and we see the 10-year very stable around 155, 165, it's hard to see after all that we've seen with the city inflation surprise index on a spike. It's really hard to see what's going to come down the road that is going to lead people to really freak out about inflation. So I think I continue to feel that the end of the inflation debate is probably going to be bullish for financial assets, for risk assets, because all the folks who are sitting outside, sitting on the sidelines, worried about that inflation surge and worried about a bond market, sell-off that will then tank the equity market. I just think that just seems unlikely to occur, and the time for it to occur is probably more kind of in the recent past. And so how the markets have reacted, and you touched on the jobs number, how markets have reacted tells me that this fear of an inflation boogeyman, as I called it in the Musings, probably is going to just gradually dissipate. And we're going to have a strong economy. We're going to have inflation being elevated relative to the recent past, but not so elevated that it's going to create a push that will force the Fed or have bond market, quote unquote, vigilantes force the Fed into doing anything that they don't necessarily want to do, or do it at a time they would prefer not to. So I think the Fed continues to be in charge. They've told us they're going to be data dependent. I expect that to be the case. And so for me, at least, I continue to think that, it's one of those dualities that I touched on in my musings a couple weeks ago, right? You have physical price pressures, very visible. You also have the digitalization of everything. So how do the two of those things kind of play out with each other? And to me, you can't have the digitalization of everything. We know that's deflationary. We know tech is very deflationary. You can't have the digitalization of everything overwhelmed by the physical price pressures, much of which is transitory because it's supply bottleneck driven. And, the system is not incapable of, over time, meeting those supply demands and eliminating the bottlenecks, and thus eliminating the dramatic price pressure.
No, that's great. And there was a great chart today in John Author's column on Bloomberg showing the labor participation rate, so the percentage of the workforce that is employed, and at the height, in the late 90s, this was like 63%, and it dropped sharply to 52 with the what they call a catastrophe of biblical proportions, with COVID, and now it's back at 58. So that kind of suggests that the Fed still has a lot of work to do, right?
Yeah, I think the Fed has been very clear. They have asymmetric inflation targeting. They're going to wait until they see the data, which supports inflation being higher than it has been traditionally, to offset to some extent the fact that it's been lower than target for so long. And that does lead to fears that inflation is going to run out of hand and create a dynamic where the Fed has to really slam on the brakes, jack rates up in the short end, and tank the equity market. I just don't think that is going to happen. I think you are going to have inflation above trend. The Fed is going to be okay with that. The bond market to date suggests it's going to be okay with it, right? No, the bond market is not suggesting at all that it's worried about embedded inflation. And so I think the onus is on the bears to make the case to say, like, the bond market's missing something. And the bond market is focused on this very issue. So it's unlikely that they're missing something. And the idea that you're going to have a period of above trend inflation lead to a sudden surge in inflation, I think is overstating the case, again, particularly in an environment where you have the digitalization of everything. And the environment where the bulk of the developed economies in the US and in Europe and in Japan are, 70% services. It's not physical price pressures that drive the economy anymore. That's not, we're not in a 1970s economy at all.
No, exactly. And it's much more services, and the services are digitalized. So, it's and I guess the biggest impact is that it takes away, all of the bargaining power that labor used to have, at some point, and in the 70s, labor used to have a lot of bargaining power. But before we move on, you said something very interesting I want to go back to, which was the JP Morgan quote, saying that growth has never been this cheap, relative to the S&P. Is that basically the same thing that you said last time about growth is just becoming GARP, growth
Yes.
at a reasonable price?
Yes.
Yeah,
which means that you're getting new buyers coming into that space, and you've had a derating of the big tech names over the last 6 or 9 months. We've talked about this. You brought it up. That's great. You're exactly correct, because I've been talking about it for a couple of weeks, because it seems like not too many other people are talking about it, and I don't really understand why. Because the fear was, and again, I was writing about this last fall, right? Vaccines and higher rates are kryptonite for big tech. That was my tagline all last fall. And to some extent, it's worked, because kryptonite kind of wastes away the strength. It doesn't kill it doesn't kill you right away. And we've seen that strength of the growth segment of the US equity market waste away. They peaked in September. And so what's happened is that they've derated. That weakening, that kryptonite, has led to them derating. And that derating has led to the environment which JP Morgan pointed out. Over 35 years, growth has never been cheaper relative to the broad market. Part of that's the broad market has gotten a little bit more expensive, right, as value and cyclicals have gone up. And big part of it is that tech has derated. So the big concern, right, if you're bullish on non-US equities, as I am, taking leadership from the US equity market, the big fear is that the US equity market crashes, because we know from experience, painful experience, that if the US equity market crashes, everything is going to go down. So the fact that we've been able to derate growth without crashing the market is very, very bullish. And that's what I call the twin engine equity market, right? That's another term I've been using quite a bit. And what I mean by that is you have growth and value both doing well. When rates go up, value does great. When rates stabilize, growth does okay. Net net, we've been able to pop all these little bubbles and all the GameStop stuff, and having the treasury go from 0.9 to 1.8 almost, to the thematic stuff like the ARK implosion, to most recently the crypto carnage I wrote about a couple weeks ago, right, where crypto had its third worst month in its history last month in May. And the equity market is close to an all-time high. And the thematic stuff really held up very well. Those are important signals that the market is telling you that, hey, it's the selling in that stuff has already dried up. And so what we've seen is actually a little bit of a rotation back into some of the thematic names, and they've actually held up pretty well. Again, something I know very well, because 20% plus of the model and 100% of the thematic model is invested in these things. And so I look at them very carefully. But these are important, subtle points that investors need to pay attention to and understand. And the fact that growth is derated and you now have these names, this is not 2000. Right? These tech stocks today, the Googles, the Facebooks, the Amazons, et cetera, they are money printing machines with tremendous cash on hand to buy back stock, to pay dividends, et cetera. And so you're going to see that, and you're already seeing it. Dividends and buybacks are picking up and provide support for the equity market. So yes, I think these are all important points that to me support not U.S. equity outperformance. It supports an environment for a leadership rotation to the non-US equity markets. Europe, Japan catching up. I expect Japan to do quite well in the second half of this year, and EM, which we touched on at the onset of the hour, with Latin America being the leader.
Yeah, and we, I guess we have three interesting topics to cover now. So. Can you wrap up, on the subject of, going from the staggered opening to the, coordinated, let's say synchronized recovery? Because now it seems like, most of the developed world is in, full opening mode. And what would that mean, for earnings? And I guess that has to do with the fact that, value has become more expensive, right? Because price has gone up, but the earnings have not, adjusted yet, and earnings. These sectors are very sensitive to they have a lot of operating leverage, right?
Yes, I think that's exactly right. Hold on a second. Do you still hear me, Roberto?
Yeah, I hear you.
Yeah. Okay. Can you see me? Because my screen just kind of went.
No, I can hear you and see you. Yeah.
Okay. I don't know what happened. I'll just keep carrying on then. Yes. I think this is an important point, and it helps one understand why inflation is probably not going to be as big of an issue, because we're having a staggered reopening, right? Just imagine if the whole world reopened all at once. You think the supply bottlenecks we have now is a problem? It would be a catastrophe in a way. So what we have instead is the staggered reopening, where we have Asia opened last fall, particularly China, US in the spring, Europe starting to reopen now, and Japan and EM following. And so that's the staggered reopening. What this means, though, because we're now entering the second half of 2021, when we come back from the summer here in the US, you again, as an analyst, you know the drill. You're immediately focusing on the out year, on 2022. And so this shift from staggered reopening to synchronized global recovery, I think, has big implications for earnings, as you pointed out. And I'll just give you an illustration. Morgan Stanley, over the late last week and over the weekend in some of their research, pointed out that Europe is not only going to grow GDP-wise faster than the US next year. The forecast for Europe in 2022 is 4.4% versus 3.6% growth for the US, both well above trend. That earnings in Europe are going to grow faster than the United States next year. 15% is the number that Morgan Stanley has penciled in for European earnings in 2022 versus 6% for the United States. And so this is the impact of the staggered reopening, that Europe is actually going to be the stronger economy as we go through the second half of 2021 and into 2022, because the US is peaking as we speak. Literally in Q2 is most likely going to be the peak of the US growth surge. And so this leads to a focus on those economies and markets which are going to be driving the train, shall we say, in the second half of the year and into 2022. And I'll just give you a couple of data points on Japan. Japan is a market nobody talks about, because now, I've been bullish on Europe, as you know, for quite some time. And now I'm quite bullish on Japan, but very few people are talking about Japan. People are talking about Europe, and fund flows are starting to move in that direction. But Japan's economic surprise index just hit a record. Their leading economic indicator just hit a 7-year high. The COVID vaccination process looks a lot like Europe. In other words, very slow to get off the mark, but picking up speed very rapidly. You're going to have the Olympics, which has been nothing but a negative headline. Most likely going to happen on time and going to be successful, in my view. You have a very cheap currency, almost 110 yen to the dollar. All these things, and you have a cyclical equity market. And all these things are happening at the same time, and yet nobody owns it, nobody talks about it. So to me, the staggered reopening giving way to a synchronized global recovery supports higher equity prices, higher earnings, supporting higher equity prices, higher commodity prices, the second leg I spoke of, and most likely higher interest rates, both in the US and Europe. So I continue to think the 10-year in the US migrates towards 2%. The 10-year Bund in Europe, as we've talked about, the benchmark for Europe, getting towards zero and probably even being positive. Very positive implications there, by the way, for European financials, which continues to be one of my favorite positions globally, and a significant allocation in the model portfolio. And so to me, this is really the opportunity set. We get to buy the laggards. And as we've talked about now, it's Europe, it's Japan, it's Latin America. And it's important that we continue to participate in these markets because they're just getting started.
And yeah, I fully agree. So there's a question from the floor about Europe. So other than financials, which you already said, would you which other sector would you overweight? I mean, I guess the domestic sectors, right? Like retail, traveling. Would that be the case?
Yes, I don't really, because there's a real lack of sectoral ETFs for Europe, right? In the US, there's virtually nothing outside the financials. So it's more expressed as a regional equity allocation in the model portfolio. And the tilt that I have on is exposure to the UK, as well as traditional or core Europe. And UK looks very appealing. Very cheap relative to its own history. Again, very under-owned, currency very compelling. And so to me, the opportunity set is a European equity exposure that includes the UK, then a separate second carve out for the financials. And that's basically the way I'm allocating to Europe. Within the model portfolio, it actually gives me an opportunity to just talk a little bit about positioning and sizing. You know, if you're doing a global multi-asset model or global multi-asset portfolio, you want to have a certain limited number of positions. And so to really target individual countries, unless there's a really compelling case, like Japan, for example, that I tend to go more towards the bigger buckets in the allocations, as opposed to trying to rifle shoot Italy or Greece or France or Spain or Germany, et cetera. Not to say that you can't be successful doing that, but if you're running a global multi-asset portfolio with a big thematic slice, so that where you might in the past have had positions on those individual countries, here, at least in my view, the opportunity set is more in the thematic space. And so that's where you're putting on a half a dozen or 7 or 8 positions that might otherwise have been gone to individual countries. I'm not sure, is that, do you follow me on that, Roberto? Am I clear? Yeah, okay. So, so that's
very clear.
Yeah, so that's kind of the way I look at it. Try to keep that model around 25 separate ETF positions. And in order to provide the space for the thematic, that means that for other things, you go a little bit bigger in the position, or a little bit, bigger in the position and fewer positions.
And here on our list, we have currencies and the dollar, to talk about. So you said, we were chatting before going live, and you said that there were, very big moves in any asset class, except for currencies. So where you see the next, big opportunity?
Yeah, no, that's a great point, and it's a good reminder, because I had kind of forgotten that we were talking about that. It's funny when you do these live, you try to keep everything in your mind, but occasionally things slip, like the talk about the foreign exchange. But absolutely right on point, and thank you, Roberto, for reminding me. So yes, the point I'd want to make is that we've had big moves in virtually every asset class so far this year, right? Equities have had a pretty big move. Commodities are leading the cross-asset year-to-date performance, up about 20%. So that's a pretty decent move. And bonds obviously have had a pretty big move, going from 0.9 to 1.75 in the space of a few months. So the only major asset class that really hasn't had a move is in the FX space. And so I'm of the view that that is going to happen, and it will happen via a weaker dollar. I mentioned at the very beginning or earlier that the dollar's on a pretty important technical support level, and it's been flirting with it, for months. But in terms of thinking about DXY here in particular, should the dollar break that technical level, then it has, fairly significant downside room to fall. And I'm not talking about, a massive sell-off of the dollar. I'm just talking about a dollar that's going to go down maybe 3-5% or so over the next couple of quarters, which will provide another support for commodities, provide another support for EM, provide another support certainly for EM local currency debt, which we're positioned for. And I think it's going to happen in large part because we're going to move from this environment where the U.S. is the strongest grower, the U.S. is the most successful with its vaccination, to this global synchronized recovery, which is going to reflect, a Europe, as I just mentioned, growing stronger than the U.S., a Japan that has, is really starting to move, and parts of emerging markets like Latin America finally coming out of this kind of long period of disappointment with COVID and economic weakness. And so to me, that kind of synchronized global recovery spells weakness for the dollar, and I expect the foreign exchange market to join the rest of the major asset classes with some volatility, and it's going to be centered around a weaker dollar.
No, makes total sense, and I share that view too. It's as you said, I mean the DXY is exactly where it started the year. Of course, for most of the year it was above the current level, and what took it there was the surprise Georgia runoff elections, and now it's fighting to it's fighting to go below 88.60 by whatever the technical level is, and I agree that once things come down on inflation and everything that you said, it's going to move down. So we're just close to the hour mark. Can we talk a little bit more on Brazil? And you talk to a lot of people, and I mean, what's the sentiment overall from either your ex sell side and Wall Street colleagues or clients you've talked to? I mean, are people getting more constructive? I mean, we've seen the flows coming up, but I mean, how do you see the mood overall?
Yeah, I think it's just at the very beginning. Some of the real smart folks I talk to and I listen to, again, that's one of the benefits of having been in the business for several decades, is that you do have your group of people that you can talk to, or folks that you read and to pay attention to them at certain points in time because you've studied their work for years and years. And I think that's a real advantage for me, again, in this world where there's so much information coming at you from all angles, to have a couple of trusted sources, kind of like I mentioned earlier with the thematic stuff and Kathy Wood at ARC, to have some trusted people that you can read or talk to, I think is very, very valuable. And I offer that obviously myself with TPW Advisory to people, but I also myself have my own group of people that I pay close attention to. And I think, we're just beginning. The move in, the Economist cover, we go back to what we started with, the Economist cover suggests that the general populace, the broad universe of people, are not yet on board with the idea that there's an opportunity in Latin American equity, or there's an opportunity in Japanese equity. People are starting to get on board with the idea that there's an opportunity in European equity, but we want to be early in that process. So when that flow comes, it can help drive us higher, right? That's where we want to be. We want to be a little bit early, where we think the risk reward is very compelling. And so that's where I think Latin America is right now. The risk reward is very compelling. The currency is got further to go. The stock market has further to go. Earnings, the economic recovery, all that has much further to go. And I'd say the same elsewhere in Japan and in Europe. So to me, it's still early days in terms of the generalist universe. But I think there's more and more interest in emerging markets. I don't think people have quite yet moved from interest in EM to interest in LATAM, right? And as we talked about earlier, just straight EEM, the broad equity ETF for emerging markets, is 70% or 80% Asian. That's the point that is not yet fully understood. And I think it brings up the last point that I'd want to make, which is I think it's very important to not sell the new leadership too early, right? If we're correct in making the case that we're early in the rotation from U.S. equity leadership to non-U.S. equity leadership, from growth equity to value equity, from commodity bear market to commodity bull market, we don't want to sell too early. And so I read about people saying, oh, Europe is up 15% year to date, outperforming the US. We should sell it. And I think that's exactly wrong. We're in the very early innings of what I expect to be multi-year, not multi-month, multi-quarter, multi-year periods of outperformance for non-US equity, for value, for commodities, and early in what I expect to be a multi-year bear market for sovereign developed market debt. And so that's the point that I want to leave us on, is that, it's important to not look at a 3-month chart and see a big up move in things like Europe, or in a month or two, big up move in Brazil or LATAM or Japan, and say, oh, we should sell it. Maybe you want to take some profit, sure, but the bigger position, we should be positioning for things that I think we're in the early phases of. And so one of the things that I'm telling clients is that to be careful not to sell the new leadership too early.
No, that's fantastic. That's very clear. And as you said, time just flies. When we do these things. Let me just see if there's more questions. Otherwise, we can just wrap up, and we just like 1 minute from the hour mark. But to add what you said, it's kind of I don't know, it always goes like this, but if you would go back to the first decade of the century and say, where is Brazil in terms of the investors flows and people believing the story, would you say we are at the end of 2003, beginning of 2004?
I really don't recall exactly where things were at that time, but I think you just look at the weights in ACWI, right? I think Brazil in ACWI is a 0.5% position. So if you're a global equity investor, you don't have to spend any time on Brazil. It's not big enough to worry about or to think about, unless you can see a real area of opportunity. And that's where I expect people to start migrating, right? Once people decide they want to be adding to non-US equity positions, that's going to be the big flow. And then where that goes, it's going to go all around the world. I personally think the developed markets ex-US are going to outperform more than EM. Having said that, I think there's a real opportunity, particularly in Latin American equity. And so I think you can have both. You can have, for example, in the global multi-asset model portfolio, we're significantly overweight non-US equity. And that's composed of positions in Europe, in Japan, and in parts of EM, particularly Latin American equity. And so you can have both, and I think you should have both. And I think the interest in Latin America, I bet one way to do it is just to go back and look at the weight of Brazil and Mexico in ACWI, at the time you mentioned. And I'm pretty willing to bet that it's significantly higher than it is today.
Yeah. So that's great. We just at the hour mark. I would like to thank our audience. We're very engaged today. A lot of questions. Thanks, Jay. Once again, we'll be sending the snippets that we prepared very soon. There's a lot of good stuff in this call, and look forward to the next one 2 weeks from now. And I don't know if you have any final words, Jay.
Yes, thank you, Roberto. I love the snippets. I think it's great editing, and it's great to get that quick soundbite across, because we do cover a lot of ground. It's a full hour of you and I going back and forth. Hopefully the audience really enjoys it. As you said, lots of good questions today, so that's great. Feel free to reach out to me directly in regards to any interest in our model portfolio delivery service. And until next time, until the next live in 2 weeks, be well. Thank you.
Thank you. Thanks again. Thanks, everyone.